Okay, thank you. Good evening, everyone. Well, welcome back to the day two of our insightful session on quantitative finance and market analysis with Mr. Shabbir Kayyumi. In our previous session, Sir provided us with a strong foundation covering basic fundamentals, technical analysis, and quantitative analysis, giving us a structured approach to understanding financial markets. Today, we move forward, building on those concepts and diving deeper into the practical application and advanced technique in quantitative finance. Get ready for another engaging and knowledge-packed session. Let's welcome Mr. Shabbir Kayyumi, sir, to take us through the today's discussion. Over to you, sir. Good evening, sir.
Yeah, good evening, everyone. First of all, good evening to everyone, and we can start the uh, session. Yeah. Yes, so we understood a lot of stuff, a lot of concepts about quantitative finance in the last session, which we were covering, and now today we are going to understand. Let's go deep dive into the another session in which we are going to talk about technical analysis and derivative analysis and much more. And maybe in the future we'll talk more on fundamental analysis. So today to start with, uh, we'll start with understanding the technical analysis. I hope my voice is clear to all of you. My screen is visible. Uh,
Yes, sir, it does. It does.
okay. So, ladies and gentlemen, okay, I do understand you all are from a technical background. You all are from a background whereby you do a lot of data analysis because the entire module itself, the course itself, talks about data science. So I think you are really interested to know much more about the data and how to do data mining, how to do data analysis, and that's where the technical analysis takes place. So let me go ahead and start with understanding the technical analysis to all of you. So to start with, there are three branches mainly when we talk about predicting the stocks or projecting the stocks or analyzing any of the stocks or maybe analyzing any of the indices in the stock market. The first one is called as a fundamental analysis, which we have seen last time also. It analyzes the intrinsic value of the assets based on their underlying economic factors, finding whether the companies undervalued or overvalued, trying to find out with the different financial models what is the intrinsic value of this company. Then using a lot of financial modelings to make it sophisticated model to find out what is the real value of the company and where the company stands right now, what is the current market price in the stock market. So the analysis which talks about all those things, balance sheets, company details, P&L statements and their business models, everything comes under this kind of analysis called as a fundamental analysis. So by looking at a fundamental analysis solely, even uh, uh, isolation also, you can find out what is the whether the stock should go up or the stock should go down, whether it is overvalued or whether it is undervalued. At the same time, we have another branch of stock analysis called as a technical analysis. So in technical analysis, we are not going to consider a lot about, we are not going to talk about the business, we are not going to talk about company, we are not going to talk about economical factors, but what we are going to see and understand what is the behavior of the price trend, what are the patterns, understanding the potential investment opportunities just by looking at the price chart. So technical analysis is a branch which completely believes that everything, price discounts everything. So everything is already in the price, and it is specifically based on Charles Dow's theory of technical analysis in 1916, which he had come out. So that's why we have Dow Jones, which have Dow theories. and all those things. So we are going to talk in detail about technical analysis, which is a branch of a stock analysis today in our this session. Going forward, we have quantitative analysis, which we have seen last time. What are the quants? Okay, so it is purely based on more on data side. Again, it is not based on the specifically on uh, fundamental analysis or the company information, but even fundamental analysis can have a quant. So mathematical models based on the data, that's where the quant comes. So technical analysis specifically on the price is taken, and we are going to talk data based on the price, where in quantitative we can have price, we can have data of other financial parameters also. So mathematical models, which talks about statistical analysis, computer algorithms. It involves large amount of statistical models, which you can do. You can do a lot of permutation combinations. You can build models. You can find out, what is a predictive analysis, and a lot more comes under quantitative. So quants, what we studied last time was the basic, in which we say quantitative analysis or the quants, where we talk about um, developing specific quantitative models on price as well as fundamental parameters. Or quants can have on a fundamental analysis, and quants can be on a price as well. So we will see quantitative analysis in detail in our further sessions. So let me introduce to you, everyone is waiting for understanding how we can predict or how we can project what is going to happen tomorrow or maybe the after tomorrow about the stock or about specifically about Nifty. So that's where the technical analyst, the specific term we call as technical analyst, comes in. So let me introduce you to technical analysis. This is basically you can even project, predict, or forecast what is going to happen in of the stock, or the specifically the price of the stock going forward. So this is it's more based on data. Okay, we can even interpret market data. We can find out what is the trend happening right now, whether it is going the process, what is the trend, underlying trend of the stock, whether it is going up, whether it's going down. You can even do you can find out even put a technical analysis on the stock, on the indices, broader indices. You can find out what is happening with Nifty, maybe what is happening in Sensex, what is happening in US stock markets, Nasdaq 100, S&P 500. You can find out what is happening in US, or you can pick up any indices in the world and find out what is happening on that indices, what is happening in that country, projecting the models. Or at the same time, you can even talk or do technical analysis on currencies, commodities, and very popular nowadays, which is crypto as well. You can do a lot of technical analysis on crypto market. So indices, equities, uh, you can have ETFs, n number of things. You can do technical analysis. Wherever there's a price, there's a technical analysis, right? So what is technical analysis? Basically data interpretation and market sentiments. So we have different methodologies, methods, and techniques to identify what is the trend right now. So what is a trend and what is trade? So I will be explaining you today some of the stuff, some of the indicators, where I will be teaching you what is trend and what is trade. What is the difference between a trend and what is the difference between a trade? Okay, so it's we can have price movements, price movement relative to volumes, where is the volume is coming. So data interpreting on the chart, and at the same time market sentiments. So you have seen in fundamental analysis we examine companies financials. Technical analysis disregards, and it it has a strong belief that intrinsic value of the asset is already there in the price. So basic idea is you have supply and demand based on XYZ business of that price of that stock, and that's how the chart patterns happens, and that's how the price movement takes place. So wherever there's a price movement, wherever there is a trend, wherever there is a movement, technical analysis is out there. So how do you do basically technical analysis? We'll see. Okay, so key principles of technical analysis, some of them. There are more out there, but I will just try to give the basic fundamental principle, which first is market discounts everything. Okay, market discounts everything means what? The price which is there right now, it is already based on supply and demand. So current market price, or whatever the price end of the day it comes, you can see EOD price, or what is happening right now in the market, which is current market price. It is already a correct price according to the branch, which is called, according to the technical analyst. What he says that this price is already the correct price. It is a perfect value because market discounts everything. So all the economical data, all the news, all the results of that stock is already reflecting in the price or in that asset or whatever, in currency or in commodity. So the technical analyst, let's say now I'm a technical analyst, I believe the price action is an ultimate indicator because price is having all the factors, all the parameters already discounted. So the first fundamental principle on which this entire technical analysis branch is established is market discounts everything. Clear? Second, prices move in a trend. So there's a pattern. If the prices are moving up, means what? Upside or downside? No, no. Continuously up, then we can call it as an uptrend. So what is the trend of the prices? It is an uptrend. If the prices are coming up and down, but ultimately going down, then we say the trend of the price is a downtrend. And when we say prices are there, which we are going to see in coming slides, so prices moves in a trend. So first we are very clear, market discounts everything. That's a fundamental principle. Second, prices moves in a trend, up, down, but ultimately up. Like this, you can see up, down, up, down, but ultimately up. If the time permits, I might end up showing you some of the charts, uh, or I might give you some charting software, and I might show you some charts. Next, history repeats itself. That is another third rule, the third principle. History repeats itself. We believe market discounts everything. We believe prices moves in a trend. And third, history repeats itself. The idea that certain price patterns and market behavior are repetitive in nature. These patterns are oftenly based on a human or a trading psychology of the human beings because they are the one who are trading, right? So as the psychology moves, or the psychology is there, which is a mass psychology. It's not a one person whose psychology is involved. So there's a mass and their trading psychology is involved. So the patterns are there which are forming on a regular basis. So we say history repeats itself. I hope this is the most important part of the entire presentation, because if you don't believe in all those three things, right, then you will not become a good technical analyst because your belief is not there. Let's go ahead. So we'll talk about trend analysis and identifying the market trends. What do you mean by identifying the market trends? So as Abhi mentioned in a previous slide, price moves in a trends. Which are those trends? There are three types of trends. One, uptrend. Second, downtrend. And third one is called as a sideways trend. What do you mean by this? Uptrend means in uptrend, ultimately price should go up. How it will go up? Up, down, up, down, but up. In downtrend, down, up, down, up, down, up, but down. So the trend is up, the trend is down. Now, if you ask me, sir, how do I know? I might end up saying uptrend, and another guy will say it's a downtrend. Someone else will say it's a sideways trend. Well, So there's a specific definition and specific rule for this. The rule is, if it is a higher high in a swing basis and a higher low, if there's a higher high pattern and a higher low pattern, at the same time, there's a lower high and lower low pattern, it's called downtrend. If it's a higher high, higher low, it is called uptrend. However, there is no clear movement. The prices are ultimately in a one range or in a one straight line or in a rectangular format. Then we say prices are in range because there is no clear direction. It is a higher high, lower high, sometimes higher high, lower low, lower high, higher low. So it's confusing. So that is whenever that is happening, it is called as a sideways trend. Again, if you get a chance and if there's a time is there, so I will try to show you what is uptrend, what is a downtrend, and what is a sideways trend on actual charting software or a charting platform. So very clear, key principles of technical analysis: market discounts everything, prices moves in a trend, history repeats itself, and there are three major trends. One is called uptrend, downtrend, and sideways trend. These are the basics. One must learn, understand, keep all these things in his mind before doing actual analysis. Now, moving ahead. So what do you mean by trend analysis? Supports and resistance. Okay. What is support? A price level when a downtrend is expected to pause due to concentration of buyers. Means what? Prices are falling, prices are falling, prices are falling. And at a particular level, you see prices stops falling. They are, let's say that is 100. Prices from 105 came to 100 and again bouncing back going to 103. From 103 again coming to 100, again bouncing back going to 102. So every time the price is falling towards 100, it is taking a support. There is a buyers which are coming in, they're buying and pushing the prices upside. So for me, 100 becomes support. At the same time, let's say there is a level called 200. Prices are going trending in uptrend. Prices are trending in uptrend, and from 180 they went to 200, took a resistance. Means what? They stopped, they paused, came down to 190, again went to 200, again they came down to 180, again went to 200. So 3-4 times they are not, the prices are not breaching the 200 level. So we can say that level 200 is a level whereby uptrend is pausing and there's a concentration of lot of sellers out there, so prices is coming down. Clear? Support and resistance. Now we have two more terminologies which I have not mentioned here. One is called as a breakout and one is called as a breakdown. What if that support which is at 100, it get breached? Means prices for the first time taken support, went to one, the second time again taken support, third time again, the fourth time prices breach 100 and went to 95. What action should a technical analyst should take? That pattern is called as a breakdown pattern. So what is happening? Support is breach, support is breakdown. Now someone can actually sell, excuse me, or someone can short sell, or someone can exit from a long position. And the similar concept, if prices are going and pushing 200 level, once coming down, twice, thrice, 4 times, and now they breach the 200 level and the prices are above 200 and they are at 20210, 205 level, we can say that the resistance which was formed at 200 is breached. It is given a breakout. Now pattern is breakout. What action a trader should take, what action an analyst should take, or what action an investor or a short-term trader should take? Now he should buy because the resistance is breached. Prices have gone in a different range. Now prices will continue to move upwards as long as they are not coming down, because we have learned prices moves in a trend unless they breach or unless they change the existing trend. We learned four things out here. One, what is support? Second, resistance. Third, what is breakdown? Fourth, what is a breakout? Action, buy, sell, long, exit. Clear? So these are all three, four basics of a technical analysis. And if you learn them, if you understand them, I'm sure you will be in a position as fast, as early as possible. You would be able to find out what this stock is going to do tomorrow, what this index is going to do later, after maybe a month later. And all these things is possible by looking at charts or finding those charts in a charting platform or a charting software or charting apps. Nowadays, you get a lot of charting apps on your mobile. You can find out and you can do that. Let me go ahead. So common technical indicators. So now we have two more things. One is called indicator and one is called oscillator in technical analysis. So common technical indicator, first is moving average, which smoothens the price, because price is always up and down, up and down. If you want to smoothen the price, you have to use moving average, which can be an average of multiple days. I can say 10-day moving average, which is a 10 days average price, and it is moving. So every day you keep adding that, which I will show you. Then relative strength index, RSI, which measures the magnitude. Okay, whether the markets are overbought or oversold, which is we call relative strength index. It's another indicator. So in a way, in technical analysis, we have 50, 100 plus indicators, 100 plus oscillators, and a huge study. And then we have different branches inside the technical analysis, called as a classical technical analysis, Western technical analysis, Eastern technical analysis, candlestick studies, wave theories, Elliott wave theories, and much more. Okay, we have objective wave theory, which is called as neo wave theory, and then we have patterns, we have classical technical patterns, we have harmonic patterns, we have wave patterns. So looking at those patterns, someone can project what is going to happen next, which we call as a post pattern implications. So it's like so simple, you look at someone's pattern, you can find out now this guy is going to shout, this person is, he's not feeling well. So whenever someone is nervous, someone is having feeling hot, or his temperature is above 100, we can say he's not feeling well. That's the pattern. Actions, post-pattern implication, give him some test, find out what is happening, and then action, give him medicines. So similarly, we can find out patterns, then we can have post-pattern implications, and then we can strongly say or suggest someone, say, look, these prices will go up from here 10-20% upside. Okay. Next one is MACD, which is called moving average convergence and divergence. It shows relation between two moving averages, how the moving averages are going with each other, whether they're converging, whether they are diverging, whether they are giving NC, which is negative crossover, they're giving PCU, which is a positive crossover, and much more. We'll try to see them in detail. So there are many things in technical analysis. Okay, I'll keep going, keep on for hours like this, and because it's a huge studies, it's not a 1 hour or half an hour, not possible. But what I'm trying to give is basic idea about how technical analysis works, what you can do in technical analysis, what is the career perspective for your technical analyst. And we have chartered market technicians, which is CMT exam, like you have CFAs in fundamental, you have CMTs in this, and you have career, you can make your career in quant, you can make career in technical analysis, and there's a lot of things to learn. However, I'm trying to give you a conviction. Okay, this theory it works, it has, there are many technical analysts in the market right now. Okay, so to start with moving average, it's smoothing out the price, because I want smoothing price, I want some line, so we have SMA, simple moving average, and which is calculated as number of days divided by prices on all the days, closing prices on all the divided by number of days, which gives simple. It's like average price, so simple moving average. Why we call moving? Because every day it is moving. So every day we calculate last 5 days average again, kind of. So every day it is going up, and so we call it as a moving average. Then we have exponential moving average. It is little bit derived formulae of SMA, which is simple moving average. It is more responsive. It is more close. Then we have a lot of derivatives of the moving averages. Like we have a Hull moving average, we have weighted moving average, we have triple moving average, we have TMAs, we have n number of double moving averages. We have Guppy, which is Guppy multiple moving average, which is very famous. We'll go ahead and talk about relative strength, RSI measuring movements. So RSI is basically you try to understand there's a price movement is going up, the prices are going up, but what is the momentum in the price? And the prices are going with a strong momentum, they're going slow, they're going really fast. What is the momentum of the price? So if you want to understand the momentum of the trend, then you have to use relative strength index, which is a RSI. So RSI is like an oscillator. I will be showing you in our chart. RSI is the oscillator. If people say RSI is going from 50, we say 50 to 60, 60 to 70, it is a very strong current. But above 70, it is in overbought zone. So prices may pause while rising. They will little bit relax, then again come down. Again, the momentum will start. So this kind of scenarios you can find out by looking at RSI. That look, prices are going up, but they are tired. They will spend some time here. Again, prices will start moving up. Similarly, prices are falling, falling, falling. And once the RSI is below 30, you might say the prices, it may happen that prices stop falling. They will pause, continue on the same sideways trend for some time, and again they either fall or again they can reverse. That we have to look for the divergences. That's where the divergence comes in the picture, which can tell us whether the prices are going to take a U-turn from a downtrend to uptrend or from an uptrend to downtrend. That we can find out with the divergence. So every tool, every oscillator is have a multiple parameters or inside or arguments inside, and looking at them, studying them, find out their values, and find out their studies, or you analyze them and you can make it out. So what is happening? So if someone asks you prices are going up, yes. Momentum is strong, no. So looking at RSI, so I feel this, I gave you the entire idea about the technical analysis, about the tools which I use. I'm going to show you some charts. Before that, I will give you some prospects about what is a rewarding career in technical analysis, skill sets required. It is an extremely competitive field. Okay, it's a unique field. You have to work a lot on charts. The charting skills are very important. How do you draw? There's a geometry out there, shapes, finding different tools, studying them, understanding them, observing them, doing a lot of data analysis. If you are going some part in advanced level of technical analysis, you can go for a back testing. You can be a coder. As let's say you are a Python coder, C++ coder, or AFL, AMI broker for a formula language coder, or Pine coder. You can do some programming in. You can make your own indicator. You can have your own oscillator in a trading view. That is also possible. So what are the job roles in financial markets? But so some of the job roles, you can get a job as a technical analyst. You can be a research analyst. You can be a techno fund analyst. Means you are studying some of the stocks in both the analysis, like technical analysis as well as fundamental analysis, both together, which is called techno funda. You can be a good advisor. When you're talking to the clients, you can be a good advisor. You can look at the charts, you can give a proper advice, and as well as at the same time you can be a good trader also, who is looking for the chart and charting movement, the price movements. Okay, so it is, what are the rewards and remuneration? It requires unique skill set. Of course, it is much different than what you guys are studying. Of course, there will be some subjects and topics in your syllabus which will talk about technical analysis. It requires unique skill set. It is a well-paid profession, yes, in India, and it is highly paid profession abroad as well. Organizations who are using technical analysis is called brokers. A lot of brokers use sub-brokers, advisors. There are trading firms. There are proprietary trading firms which can create a strategy based on the technical analysis. Hey, look, RSI should be above 50. MACD should be above zero line. and moving average 18 and prices should be about 89-day moving average, then it is a buy. And if reverse happen, then it is a sell. Put that into the trading system, find out, do back test and find out how much profit you can generate or how much alpha you can generate. All those things are possible. What is the career path, how you can go towards it. You can have a project which is about, you can do a lot of charting portfolio, you can take projects in your final year. You can have internship in different firms. Consider freelancing work on a personal projects, like you can make a project of projecting nifty for another 1 year, or maybe bank nifty or some other indices. You can talk about dollar index, you can talk about USDNR, which is depreciating right now, it has gone to 88. Work on, you have to work on different charting softwares. Observation skills, analytical skills, more important in this profession. And you can do networking in a lot of seminars and webinars happens related to technical analysis and strategies and different methodologies. You can work on your resume and different applications. This is a disclaimer from our side. This entire presentation was specifically for education purpose. There's no recommendation from my side, and there is no recommendation from my organization. Thank you so much. So I will try to show you some of the technical analysis tools. So this is specifically an Angel One trading platform which we are having. Okay, and this is charting platform. I hope my screen is visible. Okay, so this is a charting platform whereby we can find out what is happening with the Nifty 50, which is indices, which is, we can have different time frames we can select. So I selected what is happening on hourly basis, and then we can have indicators. So we have n number of indicators in which we can. So I'll just show you by putting some of the interesting indicators and how to study them in 5 minutes. I won't take a lot of time. Okay. So you go to indicator and you just say moving average. So moving average also, we have n number of options. We'll say normal moving average. Once you put that moving average, we can have settings. We can go input. So I love 89-day moving average, which is a Fibonacci number. So I put 89. Source close style, I can make it black. Okay, change the weight and just say okay. Okay, so this is how it looks. Now, for me, it is very simple that, okay, so look, whenever the prices are above this black line, which is the moving average, they go up. And when the prices are below this black line, prices goes down. That's how that can be one of the buying signal or buying indicator for me. So now I have to do a lot of blending. So it is not a one indicator concept. So you have to do blending. Then what I do is, at the same time, I go to indicators. I can say Guppy moving average, which is a Guppy multiplier. This is another indicator which I was talking about. So Guppy looks like this. Okay, Guppy looks like this. So it's a band. You see, it's a band. It's very simple. If the red band is above the green band, the prices are falling. You see, prices are falling. It's very simple. So whenever you see the red band is below the blue band or green band, the prices are rising. In this case, prices are falling. You can see. So by looking at a guppy, you can make it out if the prices are below moving average. So I can say that guppy is in a sale. Prices are below 89-day moving average. So prices are falling. If the prices are falling, I can take action of a sale. If the prices are rising, I can take an action of buy. Now I want to blend more. I can attach my third indicator. This oscillator or indicator, which is MACD. So I go, which we talk about MACD, moving average convergence diagram, MACD, and I put, and it looks like this. So this is MACD. You see MACD inputs are 12, 26, two moving averages. One is a 12, another is 26 EMAs, and this is simple. Style is this, visibility. This is the charting software which you are having. And It looks like this. So now I can say simply, okay, I will just try to give you a rough idea. Let's say, see, if the prices are above black line, like here, and prices are above guppy. Guppy means guppy is in a buy, which is green is above red. At the same time, if the prices are above zero line, this indicator blue line is above zero line, then I will end up buying. So I end up buying here, prices goes here. This is approximately 300 points movement. Okay, here we are still in buy. But the moment guppy is in a sale, prices are below this. At the same time, you see this blue line is coming below zero line. Now I can say I have to exit, or I can do short sale. So this is more called as a blending. So you take one tool, you take another tool, you take indicator, you take oscillator, you blend them, because one tool will give you momentum, another tool will give you price action, third tool will give you what is price doing right now, and that's how the system works. So this is Angelman platform. Okay, you have n number of geometrical tools you can draw. There's so many tools are there. You can draw boxes, you can draw a number of things on the chart. It's like this is your own dashboard, it's your painting board. You can do whatever you want. You can draw train lines like this. You go, okay, this is one of the way I can draw train line, and I can say, look, if the prices are breaching the train line from above, this is the time to go short with this as a stop loss and this as a target, something like that. I hope I'm pretty clear with this. And now I would like if there are any questions and answer, and so let me know them. Yeah.
Good evening, sir. Sir, am I audible?
Yeah. So if there are any questions from the audience side, I would like to take them, and we can have a Q&A
Sir, I have
session.
a question regarding the mathematical concepts. So, to
Okay.
become the one, what are the main areas of mathematical things we have to concentrate in statistics?
Okay, so here we are talking purely on the charts, or which is technical analysis. When it comes to mathematics, you have to learn a lot of data modeling. You have to I mean, quants is another separate branch whereby mathematics is used a lot. So a lot of statistical approach. So we have different options whereby you have to calculate Jensen's alpha, you have to do beta, you have to find out alpha, you have to do a lot of different statistical tools you should be aware of, and then you have to develop model, and that's how you have to work on that side when you are planning to go for quant, which is a quantitative mathematicals. It is specifically on mathematics. It is not based on chart. So chart is a visualized tool, okay, and quant is more on mathematics. So, do a lot of back testing, write a code and all that.
Okay, sir.
Yes. Anybody else is understanding, or yeah. So we can do that. Yes, you can have a lot of quantitative analysis on technical analysis. It's like simple. You write a quantitative code in a Python or in any of the Pine language on a trading view, which says that, see, if MACD is about zero, price is about 89, then buy. And if it is prices are below zero line, the MACD is below zero line, you sell. Now you have a strategy. Now you take it, put it in a quant, do a lot of back testing, do optimization, and find out, make a model in which it is well suited to the specific thing. So you can actually trade in automation or continued like algorithm trading. Yes. Trading technology. Okay, trading technology is you can have. So this is specifically manual trading technology. Okay, so you can just go on any of the futures and options. Okay, this is a trading platform. Okay, this is a Nifty future. Okay, and this is a trading platform. It's called as a dashboard. You can just open a Nifty future. You want to buy this, just click on a buy, and it opens the dashboard. You have to put money in your trading account and just place a buy order. This is one way. Second is you can write your own algorithm. You can use the Angel One API called as a Smart API. You write a Python code, you connect with the Angel One API, and then you can do automation by sale. Yes. How does one begin with the quant? If you would like to pursue a career, yeah, we spoke last time about the same. You have to learn a lot of good quantitative tools. You have to learn R, MATLABs, and Python coding should be there, and as at the same time technical analysis and fundamental analysis. So all this together, you have to learn some tools, you have to learn coding, and that's how you can make your career in quant. Automatic selling, automatic buying, automatic selling. Okay, you can do. You write a code in any of the programming language, whichever you feel, and then access that code. So there is a DMA access called as a API access. So let's say take an example. Angel One. Angel One provides smart APIs. Like these are the APIs which are similar to your technological API, like all of the software APIs. In the API, you have a buy sell. You can write your logic or algo. Hey, look, if simple, simple logic, you can write, hey, look, if the blue line is above zero, you buy, and you send that automatic signal in your trading account to the smart API, and whenever it is below this, it's a sale. So from here to here, whatever profit you have made, that will come and displayed in your dashboard. Yeah, that's how automatic trading happens. So it happens to cause something called as a smart API tool. And that is right now available with many of the brokers. At the same time, it is available with Angel One apps. So yes. Yeah, I think we'll take one or two questions more, and then uh, the last two questions. Oh, you're welcome, Tvish, Shriyam. Yeah. So may you please tell again about the portfolio we have to build for technical. So what you can do is you can find out of 100 stocks or a Nifty 50 stocks, like Nifty is having 50 common 50 stocks. Like so, how this is what Nifty is. You can I will just show you. You go to Nifty, and then you have stock composition. In stock composition, these are the 50 stocks. So out of these 50 stocks, you study them manually or through writing code or something, and you find out of this, there are 10, 12 stocks which, according to you, which are in a buy, and you suggest or you recommend them in buying. So you make an Excel file and you say, at this is the price I buy, and this is my stop loss. This is the price I buy, and this is my stop loss. So you recommend these 15 stocks or 10 stocks in your portfolio, and you run the portfolio. So whenever there's one stock hits the stop loss, you add one more. Like that, you can run your technical portfolio for a quarter or for 6 months, and it will give you a certain amount of returns. So you can find out what is the CAGR and how well your portfolio went and how much of return you are given. So that's like a small project for you. And now finally we'll take the last question, guys. Yeah. Yes.
Sir, so what is the primary difference between algorithmic trading and high frequency trading?
Okay. So algorithmic trading means what? Trading which is based on certain algorithm. So when we talk about high frequency trading, of course it is based on algorithm. Without algorithm, any kind of trading cannot be, you cannot have any kind of trading unless there's algorithm. Now, HFT is algorithmic trading. So algorithms, inside algorithm trading, there are multiple types. One is high frequency trading, medium frequency trading, low frequency trading. So when we talk about high frequency trading, it is a trading which happens, milliseconds. So buy and sell happening in milliseconds. Of course, there's a logic. Of course, there's an automatic algorithm involved out there. However, the frequency of a trade is much, high. So in milliseconds, you are having multiple trades. Okay. So when we do like that, so entire machines are working, 100% machines are working. There's no manual intervention. We'll talk about milliseconds and milliseconds. So these machines are putting the orders and they are doing buying, selling, and they have that algo, they have that decision making algorithm also inside them. At the same time, they have an execution algorithm also. So that's how HFTs are, and that's how algorithms are. So I would like to say thank you to and all the best to all this entire IT Madras students. Uh, my wishes with them. Thank you so much.
Sir, I would also like to thank you for this session, sir. And your guidance will definitely help us in breaking into the quantitative finance or any other finance domain, specifically in public markets. Uh, Thank you, sir.
Thank you so much, guys, and all the best.